Something unusual just happened in the financial markets, and almost no one is talking about it the way they should. In a moment when global tensions are rising, when war risks are increasing, and when uncertainty should be pushing safe haven assets higher, silver did the opposite. It dropped, and not quietly, but sharply enough to raise serious questions about what is really driving the market beneath the surface. Because like gold, silver has historically responded to instability with strength. It is both a monetary metal and an industrial asset, tied not only to investor fear, but also to economic demand. During times of crisis, especially those involving geopolitical conflict, capital typically moves into tangible stores of value. But this time, the pattern appears to be breaking, and that break is what makes this moment so significant. The immediate backdrop is a world under pressure. Conflicts are intensifying across key regions, supply chains remain fragile, and central banks are navigating one of the most aggressive tightening cycles in recent history. These forces are not isolated, they are colliding, and when they do, they create distortions that can push markets in unexpected directions. At first glance, the explanation seems straightforward. Rising interest rates increase the attractiveness of yield-bearing assets, pulling capital away from metals like silver. A stronger dollar adds further pressure, making commodities more expensive globally. But that surface-level reasoning does not fully explain the speed or timing of the decline, especially in an environment where risk should be driving demand upward, which leads to a more uncomfortable possibility that the movement is not purely organic. In modern markets, price is not determined solely by supply and demand. It is influenced by liquidity, leverage, and the structure of financial instruments tied to the asset. Large institutional positions, derivatives, exposure, and algorithmic trading can amplify moves far beyond what fundamentals alone would suggest. And during periods of stress, especially those influenced by war and financial tightening, investors are often forced into decisions they would not otherwise make. Assets are sold not because they are weak, but because liquidity is needed elsewhere. Margin calls, portfolio rebalancing, and risk reduction can trigger cascading effects, pushing prices down even in assets traditionally seen as protective. This is where the narrative shifts, because a falling silver price during global tension may not signal confidence. It may signal strain. A system under pressure, where capital is being pulled in multiple directions at once, revealing cracks that are not immediately visible. And if that is the case, then the drop in silver is not just a market move, it is a message. If you want to understand what that message could mean, and how war, monetary policy, and hidden financial mechanics are shaping the assets you rely on, subscribe now. Because what looks like a simple price drop may be something much bigger. To understand how silver reached this point, it's necessary to look at the broader timeline that has been building beneath the surface for years. After the global financial crisis, central banks flooded the system with liquidity, pushing interest rates to historic lows and encouraging massive capital flows into risk assets and commodities alike. Silver benefited from this environment, rising alongside gold, as investors sought protection against currency debasement and inflation. But over time, the structure of the market began to change. The rise of derivatives, exchange-traded funds, and leveraged positions transformed silver from a largely physical asset into one heavily influenced by financial engineering. This meant that price movements were no longer driven purely by industrial demand or investor sentiment, but increasingly by positioning and liquidity conditions. As the global economy moved into the 2020s, new pressures began to emerge. Supply chains were disrupted, geopolitical tensions intensified, and inflation surged to levels not seen in decades. Initially, this should have been supportive for silver, but at the same time, central banks pivoted sharply, raising interest rates to contain inflation and strengthen currencies. This shift marked a turning point. Suddenly, the cost of holding non-yielding assets increased, and capital began rotating into instruments offering higher returns. The dollar strengthened, further pressuring commodity prices globally. Then came the layer of geopolitical stress. Conflicts across multiple regions began influencing energy markets, trade routes, and investor psychology. In previous cycles, such instability would have driven a strong rally in precious metals. But now, these forces were colliding with tightening liquidity conditions. Large institutions facing volatility in equities, bonds, and other markets were forced to rebalance, sometimes liquidating positions in silver not because of its outlook, but because of broader portfolio pressures. This created a feedback loop. As prices began to fall, leveraged positions were unwound, triggering further selling. Algorithmic trading systems responded to momentum, accelerating the decline. What might have started as a rational adjustment quickly turned into a cascade, where technical factors amplified the move beyond fundamental justification. At the same time, industrial demand, another key pillar for silver, faced uncertainty as global growth expectations weakened under the weight of higher borrowing costs and geopolitical risk. This dual identity of silver, both monetary and industrial, became a source of vulnerability rather than strength. The result is a timeline where multiple forces, monetary tightening, financial structure, and geopolitical stress, have converged into a single outcome. A decline that appears contradictory on the surface, but begins to make sense when viewed through the lens of a system under pressure, adjusting rapidly to a new and more volatile reality. The mechanics behind the silver crash become clearer when the sequence of events is examined step by step, revealing how multiple forces aligned in a very short window. It often begins with a shift in expectations, signals from central banks that interest rates will remain higher for longer, immediately strengthening the dollar and pulling liquidity toward yield-bearing assets. Almost simultaneously, geopolitical tensions escalate, creating uncertainty across markets. Under normal conditions, this would attract capital into silver, but instead, institutional investors, already exposed to volatility in equities, bonds, or energy markets, begin reducing risk across the board. That includes selling silver. From one perspective, this is simply portfolio management. Funds rebalance, reduce leverage, and move into cash or safer yield instruments. But from another perspective, it reveals something deeper about market structure. Much of today's silver trading is not driven by physical buyers or long-term holders. It is driven by large financial players operating through futures contracts, ETFs, and algorithmic systems. When these players move, they move size. And when they move quickly, the market follows. As selling pressure builds, technical levels begin to break. Stop-loss orders are triggered. Algorithms detect downward momentum and amplify it. What started as a controlled adjustment becomes a cascade. Each layer of selling feeds the next, pushing prices lower at a speed that appears disconnected from real-world supply and demand. At the same time, margin calls force leveraged traders to liquidate positions, adding further pressure. There are also competing narratives about what this means. One side argues that the decline reflects confidence in monetary tightening, that markets believe central banks will control inflation, reducing the need for safe haven assets. The other side sees it differently, suggesting that forced selling and liquidity stress are distorting prices, masking underlying risk, rather than resolving it. The evidence is mixed. Data shows increased volatility in derivative markets, large flows in and out of silver-backed funds, and heightened sensitivity to macroeconomic signals. Yet there is still uncertainty about how much of the move is structural versus temporary. That uncertainty is what makes the situation so complex, because in a system this interconnected, price is not just a reflection of value, it is a reflection of pressure. And when pressure builds across multiple fronts, financial, geopolitical, and monetary, the outcome is rarely straightforward. What makes silver's position uniquely strategic in this environment is its dual role at the intersection of industry and finance. Unlike gold, which is primarily a monetary asset, silver is deeply embedded in global manufacturing. Used in electronics, solar energy systems, and advanced technologies that power modern economies. This gives it intrinsic demand tied to economic growth, but it also exposes it to slowdowns when financial conditions tighten. In a period where war and geopolitical tension are disrupting supply chains and raising uncertainty, industrial demand becomes less predictable, weakening one of silver's core supports. At the exact moment, its safe haven role is being challenged. At the same time, the infrastructure surrounding silver markets has evolved into something far more complex than physical trade. Major trading hubs, futures exchanges, and financial institutions now dominate price discovery. This means that strategic decisions, whether by central banks, large funds, or even state-backed entities, can influence silver prices indirectly through currency movements, liquidity conditions, and broader market positioning. In effect, silver has become part of a larger system where its value is shaped not just by its own fundamentals, but by the dynamics of global capital flows. Geopolitically, this matters because resources like silver are increasingly tied to national strategies as countries compete for technological dominance, particularly in renewable energy and electronics. Control over critical materials becomes more important. Any disruption in access, whether through conflict or policy, can ripple through industries that depend on these materials. This adds another layer of strategic importance, linking silver not only to financial markets but also to long-term economic and technological competition. From an operational standpoint, the implications are immediate. Mining output can be affected by political instability in key producing regions. Transportation routes can face delays or increased costs. Financial restrictions or sanctions can alter how and where silver is traded. Each of these factors introduces friction into the system, increasing volatility and uncertainty. Taken together, silver is no longer just a commodity reacting to market sentiment. It is a node within a complex network of financial, industrial, and geopolitical forces. And when those forces begin to pull in different directions, as they are now, the result is not stability, but tension. A tension that can manifest in sudden, seemingly contradictory price movements, revealing just how interconnected and fragile the system has become. According to financial analysts and geopolitical experts, the recent drop in silver is being interpreted less as a simple market correction and more as a signal of underlying stress within the global system. Institutional reports increasingly highlight how tightening monetary policy, combined with geopolitical instability, is forcing a repricing of assets across the board. In this environment, silver is not being evaluated in isolation. It is being pulled into a broader adjustment where liquidity, risk exposure, and capital preservation take priority over traditional asset behavior. Analysts note that when multiple markets experience volatility at the same time, even assets typically seen as protective can be sold to meet short-term obligations. Intelligence-style assessments often focus on liquidity as the key variable. When liquidity contracts, the entire system becomes more fragile. Funds that rely on leverage are particularly vulnerable, as they must maintain certain capital levels. If losses occur elsewhere, whether in equities, bonds, or currency markets, positions in assets like silver may be reduced or liquidated to stabilize portfolios. This creates a dynamic where selling pressure is not necessarily linked to silver's long-term value, but to immediate financial necessity. At the same time, think tanks studying commodity markets point out that silver's industrial role adds another layer of complexity. As global growth expectations weaken under higher interest rates and geopolitical uncertainty, projections for industrial demand are revised downward. This shifts sentiment, reinforcing the downward movement and creating a narrative that supports continued selling. Even if underlying supply conditions remain tight, military and geopolitical analysts also emphasize that resource competition is intensifying. Materials like silver, critical for technology and energy infrastructure, are increasingly viewed through a strategic lens. While this could support prices in the long term, short-term market behavior is dominated by financial flows rather than strategic accumulation. In other words, the forces that should be pushing silver higher are being temporarily overridden by financial pressure. Experts also caution against assuming that price reflects stability. In complex systems, prices can move in ways that mask underlying risk. A falling price during a period of rising global tension may indicate that capital is being stretched thin, that liquidity is becoming scarce, and that institutions are prioritizing survival over positioning. This convergence of expert perspectives points to a single conclusion: the silver crash is not just about silver, it is about the condition of the system itself, how it responds under pressure, how it reallocates capital, and how it reveals stress in ways that are not always immediately obvious.